Everyone have heard of a dividend yield of 4 to 5%. In rare cases, you might have heard of a yield of 10 to 12%. But have you ever heard of a 40, 50, or what about a 60% dividend yield? Of course not. How can any company give such a high dividend? Theoretically, this is almost impossible. But from a technical standpoint, there are certain mechanisms in place that can make it possible. And let me tell you, a great number of investors are actually doing this today. This means on a 10,000 rupee investment in shares, you can get a dividend of up to 5,000 rupees. If you want to understand these systems, make sure to watch the video till the end. Today, I am going to tell you about 3 powerful dividend investing strategies with which you can actually increase your total dividend income to a great extent. Maybe you can double it or even triple it. These strategies are not just theory. I will show you with exact calculations, with actual real market data and lot of verified sources that how this works. And that is why we will discuss 3 different investment strategies with you today. And all 3 have different methods and a totally different approach. But the motive of all of them is the same, to increase the investor's dividend yield. Now just think about what could happen if you get a dividend yield of 40 or 50%. Well, a 50% dividend yield means that someone invested 10,000 rupees and earns 5,000 rupees every year. If this continues, your invested money can double every 2 years. I realize this might sound a little bit impossible right now, but do not worry, I will prove every single system to you. I'm not suggesting that everything is going to be different tomorrow. You won't get a 50% dividend yield just by pressing a button. That is not how it works. If that were the case, I wouldn't be making this particular video today. I would be pressing that button. See, in this system, you have to give the market some time. You have to wait for the right opportunity. However, if you choose to skip through this video, I promise that you will not understand anything at all. Or you will say it is wrong. Look, if you want to understand the system properly, just give me 15 minutes. I will explain everything to you in complete detail. Let's begin. Let's say company A's stock is 200 rupees and it gives a dividend of 16 rupees per share annually. So what is its dividend yield? 8%. It's simple math. Simply divide 16 by 200 and then multiply by 100. This means if you had invested 10,000, you get 800 rupees in annual dividends. If you invest 1 lakh, you get a dividend of 8,000 rupees every year. This 8% dividend yield is merely the starting point. I am now going to present 3 particular strategies that you can implement so this 8% yield can be doubled. Maybe it can even be tripled, or it could even go up to 50%. So let's start with the system number 1. This system is very simple. For this particular system, you don't need to have any technical knowledge or complex calculations for this. You just need to have a little understanding of how the market actually works and a somewhat risk-taking ability. That's pretty much it. But this system doesn't work every day. About once in 8 to 10 years, such an opportunity arises when investors can really make use of it. If you simply play the right bet at the right time and the market fully supports you, then with this strategy, it's possible to earn a dividend yield of up to 40 to 50%. See, the total amount of dividend a company gives depends strictly on the company's profit, not on its stock price. Essentially, the dividend Coal India pays each year does not rely on its stock price, but on the company's annual profit and determined by the company's internal dividend policy. Essentially, the higher the profit, the higher the dividend can be. And the dividend policy is decided by the board of members. For instance, from 2014 to 2018, Coal India paid average yearly dividends ranging from 20 rupees to 29 rupees per share. In that time, Coal India traded between 240 and 450 rupees. There were 2 or 3 rallies in between, but most of the time the stock price was trading around 300. This implies you can earn a yield of 8 to 10%. Now in 2020, the COVID crash came and Coal India dropped to 100 rupees. Assume that someone took advantage of this opportunity and in 2020 bought Coal India's share at 100 rupees. Now in the next financial year, that is from April 2021 to March 2022, Coal India issued 17 rupees 50 paise dividends. That means for the person who bought at 100 rupees per share, the dividend yield for that person became 17.50%. In FY23, the company paid 23 rupees 25 paise. So that investors' dividend yield became 23.25%. For FY24, they had paid around 2450 rupees. So the investors' dividend yield hit 24.5%. In FY25, the company paid 26 rupees 25 paise, meaning that the investors' dividend yield became 26.25%. Though Coal India's current price is around 400 rupees, if you look at the current price, the yield is only 6 to 7%. But by entering at the right time, the yield is almost 4 times more. On top of that, the capital gain is separate because the 100 rupee share became 400. Isn't that an amazing strategy? Whenever there occurs a large crash in the market and the market starts to bottom out, take the opportunity to invest in high dividend companies. After a year or two, the yield will be very high. There is only one difficulty in this whole strategy. The difficulty is figuring out when the market will bottom out. While it is certainly difficult, perhaps impossible, when a major market crash arrives, keep investing small amounts of money over time. You'll average out. Even if you don't get the share at 100 rupees, you might get it at 120, which is quite good. History shows that in the Indian stock market, a major crash occurs every few years. Whether it's geopolitical tension, war, a pandemic or an economic crash, let me give you some interesting data. Look carefully. On 8 January 2008, the Sensex was at its peak. It was at its lifetime high, at 21,206 points. Then the global financial crisis of 2008 struck and the whole market crashed. By March 2009, the Sensex had fallen to 8,000 points. That means a massive fall of almost 62%. But look exactly 1 year after this. In March 2010, the Sensex had reached 18,000 again. 6 months later, in November 2010, it reached 21,000 again. And just like that, the crash ended. It fully recovered in just 1.5 years. Look at the 2020 COVID pandemic data. By January, the Sensex hit 42,273 points exactly. It hit record highs. By March 2020, Sensex had crashed and fallen to 25,981 points. 40% market crash. However, precisely 8 months after this point, the Sensex had climbed to 45,000 levels and was making a new lifetime high, meaning a full recovery in just 8 months post-crash. The moral of this story is that you really should not be afraid of a market crash, but rather use it as a great opportunity. Always remember a very famous quote by Warren Buffett. Always be fearful when others are greedy and be greedy when others are fearful. This effectively means when there is a crash in the market, you should buy, and when the market is touching its lifetime high, you should book profits. Let's say before the crash, you were getting company A stock for 200 rupees. Paying 16 rupees dividend, meaning the yield was 8%. Now the market crashed. It crashed over 50%, much like it did in 2008 and the dot-com bubble. So you will get the same stock for 100 rupees. If the dividend stays at 16 rupees per share and you buy the share for 100 rupees, then your dividend yield will effectively become 16%. And if the stock crashes by 60%, then your dividend yield will become 20%. And if the stock crashes by 75%, the dividend yield you get will then be 32%. Assuming that the company will maintain the same rate of dividend. But remember one crucial thing here. How much dividend a company will pay depends on the company's profits and dividend policy. It's not like a guaranteed fixed return like a bank FD. So invest thoughtfully. And yes, an important thing, just because a stock is available very cheap does not necessarily mean it can ever go up again. In every market crash, there were many companies that had to completely shut down. So before you start investing in any particular stock, make sure to do your own research. And if you don't know how to do a detailed analysis, then take advice from a proper SEBI registered research analyst. It's better to pay a professional fee of 4 to 5,000 than waste lakhs of rupees. Don't invest on advice from friends or random tips. Now coming to the second system, but if you enjoy this, please like this video so that we can gain the motivation to do detailed research and produce more high quality videos for you regularly. But before moving ahead, I want to briefly tell you about our sponsor for today's video, which is WealthBuilding. WealthBuilding has truly made bond investing so very easy and accessible that you can start with just 1,000 rupees today. In simple, clear words, a bond is a loan that you give to a company or the government, and in exchange for this, you get a fixed interest, generally between 9 to 12%. This fixed return depends on the bond you choose, and that too either monthly, quarterly or annually, whichever way you prefer it. Direct deposit in your account. Once, bonds were strictly for the big players. Now you can begin investing in bonds with just 1,000 rupees and earn a steady fixed return every single month. And the best part is that the entire investing process is absolutely seamless. Whether it's UPI or net banking, the work is done in a few minutes. Plus, you get a powerful dashboard where you can track your investments in a thorough way, where you can also see the repayment schedule, and not just that, even smoothly reinvest automatically. Here, every bond issuer undergoes a quarterly audit and full due diligence is done. Not just any company's bonds are listed on this platform. These bonds are all listed on the exchange. So if you ever need money in between, you also get liquidity. You can sell them directly on their website. And most importantly, on this website, you can also start investing with just 1000 rupees. So if you also want to start bond investing, then after the video ends, create an account on Vint Wealth from link in the description and put your hard-earned money to work. Now coming back to the topic. Before going into the second strategy, you first need to understand the long-term average return of the Indian stock market, because this data will be very useful later. And let's also see how the market works in the long term, because this data is going to play a very important role in our strategy. BSE Sensex, seen as India's oldest and most reliable stock index, was set to 100 points on April 1st, 1979. Up until 2020, it has effectively given a compounded annual growth rate of 15.9%. This data comes from the official HDFC Mutual Fund report. I have provided the link in the description for you to verify. On the other hand, the NSE Nifty 50 index has been tracked since 1999 and it has given a CAGR of 14.2%. In last 20 years, Nifty has approximately given a CAGR of about 12.92%. So when I am showing you the calculations for the second system, we will assume a growth rate of 12%, which is based on verified Indian market data. Why does this matter? Because if you invest for the long term, it's very important to have a realistic expectation. Even if the market is up 40% in 1 year, it doesn't happen every year. A 12% return means your investment almost doubles every 6 years. Now let us come to the strategy. Using this strategy, we are going to combine the market growth with dividend growth. The strategy effectively works when you will invest in quality companies that are currently in their growth phase and are also consistently paying dividends. Assume company A stock is not constant at 200 rupees, but it is also growing annually in line with the market. It's growing at an average of 12%. Since the company sales and net profit would also rise 12 to 15% annually here, and the company is maintaining its same dividend policy, ensuring the company dividend also grows at 12% yearly along with profit. This is the assumption on which the calculation of this strategy will be based. Let's look at an interesting calculation. Suppose that you invested 1 lakh rupees, meaning you have bought 500 shares at 200 rupees each. In year 1, you will get a dividend of 16 rupees per share. So on your investment of 1 lakh, the dividend will be 8,000 rupees. That is an 8% dividend yield. Now after 1 year, the stock price increased by 12%. 200 multiplied by 1.12 equals 224. With sales and profits also growing, the company increased the dividend by 12%. To keep an 8% yield on market price, what is the dividend? 224 multiplied by 8% equals 17 rupees 92 paise per share. You have 500 shares, so the total dividend will be 8,960 rupees. If we compare it with your initial investment of 1 lakh, then your yield to cost will be 8.96% per annum. Next year, the stock price will increase 12%. Multiplying 224 by 1.12 gives 251 rupees. The company's sales and profits must have also gone up, so they would have increased the dividend by 12% to maintain an 8% yield on market price. What is the dividend? 251 multiplied by 8% equals 20 rupees 7 paise per share. You have 500 shares, that's 10,035. If we compare this to your total initial investment of 1 lakh, your overall yield becomes 10.04%. Assuming that this same steady trend continues, stock price after 6 years will reach 395 rupees. By year 7, 442 rupees. This is actually 2.2 times your original entry price, meaning it's simply more than double. 7 years later, what's dividend per share? 35 rupees 38 paise. Now what will be your yield on cost? 35.38 times 500 shares equals an annual dividend of 17,688 rupees. If we divide this by 1 lakh, the yield is 17.69%. This means in just 7 years, your 8% dividend yield changed and became more than double. After 10 years, 24.85%. After 15 years, 43.87%. At 20 years, your yield hits 77.53%. That is almost 10 times more than your original 8% dividend yield. Now think, you had invested only 1 lakh rupees and now you are getting 77,528 rupees every year just from dividends. Plus, the value of your shares will be above 9 lakh. This is the real power of long-term equity investments. But I must mention an important note here. This strategy that I have discussed only works best when you choose quality large cap companies that show consistent growth and also maintain dividends. The Indian market offers many such examples like Asian Paints, HUL, ITC and SGFC Bank. For example, look at the dividend trend of Bajaj Finance. In FY21, the dividend was 10 rupees per share. In FY22, it was 20 rupees and in FY23, 30 rupees per share. In FY24, 36 rupees per share. In FY25, 56 rupees per share. This clearly means in the last 5 years, their dividend yield has increased by almost 5 times. If you are going to invest in these kinds of stocks for the long term, your dividend yield will also increase rapidly with the stock price. But all this is just an example, based on past data. Always remember one important thing in the stock market. Please note that past returns or performance are never a guarantee of future returns. So consider all these data points only as an example for learning. Please do not take any of these points as a recommendation to buy or sell. If you desire professional recommendations for buying or selling shares, please take advice from a SEBI registered research analyst. Now, after having discussed this, let's come to the last but not the least. This strategy, in my opinion, is the most powerful system for long-term wealth creation, as well as for regular income. This strategy is the best. Even if your company's stock price in the open market is not growing today, your dividend yield can still effectively increase. This strategy uses the power of compound interest. I will show you with exact calculations step by step. Let's say you have invested 1 lakh rupees in company A, which is trading at 200 rupees per share. It yields 8% in dividends. So how many shares will you get? 1 lakh divided by 200 equals 500. How much dividend will you get in the first year? 500 shares at 16 rupees brings a dividend of 8,000 rupees. Now, the most important decision here is to not spend those 8,000 rupees, but reinvest it in the same stock. How many new shares would you be able to buy with 8,000 rupees? 8,000 divided by 200 equals 40 new shares. So by the end of the first year, you will hold 540 total shares. For year 2, you receive dividends on your 540 shares. Let's assume a dividend of 16 rupees. Your total dividend will be 8,640 rupees, which is 640 rupees higher. You will also reinvest this money, from which you can buy almost 43.2 shares. From this point, you just have to continue the same process. After 10 years, you will have 1,079 shares of stock, that is more than double. Now, how much dividend will these 1,079 shares give you? 1,079 multiplied by 16 equals a total of 17,271 rupees per year. What was your initial investment? 1 lakh, thus your dividend yield on cost becomes 17.27%. That is almost double of your 8% yield. This is the power of reinvesting. Now, if you keep reinvesting the dividend money in this way for the next 20 years, then you will have a total of 2,330 shares accumulated, and you will get an annual dividend of 37,288 rupees. Your yield has become 40.27% on cost. That is almost 5 times more than your original 8% yield. This strategy is the snowball effect. The more the shares you have, the more dividend you can claim from it. The more dividend you get, the more new shares you can now purchase. This cycle continues. But remember one important point. In this calculation, I have assumed that the stock price and dividend will remain constant. In the real world, both the stock price and dividend will always fluctuate. But this simplified calculation shows us the power of reinvestment. Plus, if the price actually grows, the overall returns can be even higher. Now let's finally come to our master strategy. Now imagine, what if you combine all 3 of these strategies? With just one strategy, your dividend yield can double or triple. If you combine all 3, it might become 10 times. First of all, during a market crash, evaluate and buy the best quality dividend stocks at a discounted rate. Then also reinvest the dividends you receive from them. And thirdly, if both the current stock price and dividend payout start to increase in the market, meaning that growth actually starts in the stock price, then in 20 years, your 1 lakh rupees can potentially become 40 to 50 lakh. This is an approximate calculation because the real world has variables and prices keep going up and down constantly. The power of compounding is truly insane. This is how real long-term wealth creation happens. I have also put a comparison table in the Excel sheet where you can clearly see how the performance of all of the 3 strategies compares. This is based on 10 and 20 years data. This visual comparison that I'm sharing with you here will also help you in deciding which strategy is best for your goals. If you want regular dividends and want to simply use that money, then go ahead and use that money. But if you really have any scope to reinvest that same money, then reinvest it to see power of reinvestment and take advantage of that growth in the long term. Now keep some important points in your mind. First is taxation. In India, dividend income is taxable according to your slab rate. So in all the calculations I have shown, I have not considered taxes simply because the tax slab rate for every individual can be different. Some are in the 5% bracket, some in 20 and some 30. Tax reduces your real returns. Similarly, when you are going about selling shares, capital gains tax will also be applicable. If you are simply holding the shares, there is no problem. In our strategy, we have to hold them. The second point is that this calculation assumes that the company is consistently paying dividends. In real life, companies can cut dividends at any time. In times of recession or poor performance, companies also cut dividends. So you should choose fundamentally strong companies that actually have a very long and established past track record of making consistent dividend payments. Third, stock prices are not constant. In the strategy, I had assumed that the stock price would remain constant, meaning you would get it for 200 every single year and you would keep buying it. But this calculation was only for simplification and to show the reinvestment effect. In the real market, prices fluctuate, which can have an actual effect on your reinvestment cost. Fourth, you absolutely must diversify. Look, don't put all your money in a single stock. Create a portfolio of dividend stocks with 10 to 15 quality dividend paying stocks across different sectors. This strategy helps to reduce risk and keeps the income stream stable. Why only stocks though? If you really want, you can instead invest in these real estate investment trusts and invest in India's top real estate and commercial properties starting with just 500 rupees. From there, you will also get rental income and see the long-term benefit of capital appreciation. If you want to understand this entire system in detail, how it works and how much yield you can get from it, then definitely check out this video of mine. In this particular video, I have explained everything in proper detail. I have put all the links in the description below, so be sure to check it after the video ends. And yes, you can actually also invest in these quality infrastructure investment trust where with just 100 rupees, you can invest in India's top highways and earn toll income. With just 500 rupees, you can invest in solar projects and power transmission lines and earn a regular income. I have dedicated this video to explaining in great detail exactly how you can earn a yield by investing in highway InvITs. Be sure to check it after the video ends. I have put the link in the description. And yes, remember, wealth creation is a marathon, not a sprint. If you found this video and its information helpful, then like it, share it with all your friends, and yes, for more such interesting content. Don't forget to subscribe to the channel. Jai Hind.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.